This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. But here we had quite a long chat last time, which I'm not going to repeat all the talk bit. But you've got to be able, not for a lot of marks, you'll never want the great long essays, but you've got to talk sensibly about ways in which companies can raise long-term finance. That essentially, if I need to raise 100,000 to expand the company, the choice is basically either raise it from shareholders, and to raise money from shareholders, we either issue new shares to the public, which is okay if you're a great big quoted company. That's virtually impossible for a small company like me. The general public haven't heard of me and no way would be buying my shares. Or you have a rights issue, and there's nothing to write down for the minute. I'll say more when we need. But a rights issue where you're issuing new shares to existing shareholders and raising the money that way. Or the most common way of all of getting money from shareholders, to retain earnings instead of paying all your profits out as dividend. Clearly most companies keep a lot of the profits back. Effectively they're borrowing money from shareholders and using that to expand. Agreed? But you've got to be able to talk properly about ways of raising money just for the written. Equally, borrowing money, long-term borrowing. It may be for a small company as simple as take a bank loan. Yep. Or, I said before, and the examiner always mentions for a small company, if you need to borrow money, even before you go to the bank, look to any rich friends or relatives and try and borrow money from them. Or, I'll remind you shortly rather than talk now, if you're a large quoted company, issue traded debt, loan stock bonds, whatever. Well, I'll remind you of the bits you need on that after. Anyway, apart from that little, if you like, introduction, for most of the written side of it, I'm going to hand you out shortly 3 or 4 sheets. To spend all afternoon talking through it would be silly. I'll give you 3 or 4, if you like, summary sheets containing most, if not all, of what he expects you to know, if you understand me. You know, saying slightly more about what I've just said. There'll never be massive writtens, but on this area, there do stand to be potentially several written bits talking about ways you can raise long-term payments. Okay? I say I'm not going to talk through all of that. It's better you see by questions and by reading my notes. The bits of arithmetic that can go with this are fairly limited. But I'm going to check them with, I think, in total 4 sheets. The first one is on valuing shares. That he could give you information and ask you to work out the market value. The market value? Value on the stock exchange, effectively, of a share. I said earlier that in theory, and for any arithmetic you do in the exam, the value of a share, the price on the stock exchange, the price people are prepared to pay, it depends on the dividends that shareholders expect and the rate of return that shareholders require. Now, if you look at A with me, the required return of shareholders is 12%. It's a separate problem. Why? That's a separate issue we'll come to later. For whatever reason, shareholders want a 12% return on their investments. They're expecting a dividend of 30 cents a share. Well, I say again, in theory, and for any numbers in the exam, the price you'll be prepared to pay will be whatever makes the dividend a 12% return, if you understand me. And here, the most baby one of all, this should be common sense, to be honest, but make sure. Normally we'll use a formula. I'll come to the formula, but because of any writtens at all, check you're happy with the baby one and you see the logic. Shareholders are expecting a dividend of 30 cents per share. Divvy, 30 cents per share. They want that to be a return. Their required return is 12%. All you're ever doing is you're saying the amount you'll be prepared to pay is whatever makes 30 cents equal to a 12% return. And although there is a formula, I'll come to it, do see the logic in this baby one, that in theory the price they're prepared to pay, the market value, it must be 30 cents divided by 12% or 0.12. In theory, they're prepared to pay... Well, somebody just check the numbers. Is it 2.50 cents or $2.50? And I say I really shouldn't need to go through this, but it's just I'm scared about writtens. The point is, if you do invest 2.50, a 12% a year return on it, well, 12% of 2.50 is 30 cents. All we've done is work backwards. If you want 12%, maybe you can get 12% from the bank. If you're going to get 30 cents a year, then in theory, you're prepared to pay $2.50. All right? I only did that one because, as I said, I think you should be happy with the logic for little bits of written. However, any share valuations in the exam, you're given a formula. The formula's on the formula sheet under the heading the growth model. The formula here gives you, again, it's back to not having any symbols, but not defining the symbols, but the price, P0 is equal to D0 times 1 plus G over RE minus G. It is really just learning the symbols and then being careful. The P0 is the market value that we're after. D0 is the current dividend. G is the rate of growth in dividends, the dividend growth rate per annum. And RE is a stupid examiner. In different formula he uses different symbols for the same thing. But in this formula, RE is the shareholders' required rate of return. And in the exam, it's never, ever very many marks, but it's very common. But a tiny bit of a question, part A, 3 marks or something. If he asks for a market value of a share, all you're doing is sticking figures in the formula and come out with a value. My baby one here is too easy. But of course, repeating it, here, the current dividend was 30 cents, if I work in cents. In the example we've just done, at what rate are dividends growing? Pardon? 0, surely. Now, what made it baby is usually, if people buy shares, they're expecting that dividends will grow 2%, 5% a year. In this baby one, where it was a constant dividend, surely it is constant dividend, the rate of growth is 0. And so the formula becomes trivial. 1 plus G is 1 over required return, 12%, 0.12, minus G, well, if the growth is 0, it's back to what we had before. 30 over 0.12 was 250 cents or $2.50. Arithmetically, is everybody clear? I said the reason I did what I did first, be able to write a few lines about the logic. But otherwise, you just, for the numbers, you're just sticking figures in a formula. All right? However, in the exam, there's almost no question he makes it slightly more fun by having shareholders expect growing dividends. And of course, if you do expect dividends to grow, 5% a year, 10% a year, whatever, then of course we need the full formula. You agree? Very often he just tells you the growth rate. I'm not going to waste time, but if I gave you the same question but said, dividend 30 cents this year, it's growing at 5% a year, well, I hope we can all stick it in a formula, we'll check in a minute. If he wants to make it slightly more marks, he'll ask you to estimate the growth rate. And so question B, parts 1 and 2 go together. If you look first of all at part 2 for the moment, part 2, it says what will the market value be of shares if the shareholders' required return is 14%? Well, to use the formula, we need to know current dividend, but we also need to know the dividend growth rate. Agreed? Well, as I've said, he'll either tell you the growth rate, and if he says it's 5%, you use 5%. Or, to estimate growth rate, he'll do something similar to what I've done in the first bit of it. Instead of telling you the growth rate, I've told you what the dividends were in the past 5 years. Don't copy this bit down, you've got it in front of you, but then I've got it. In 97 the dividend was 10 cents, in 98 it was 9, 99 it was 12, 13. So those are the dividends over the past 5 years. Clearly there's not a constant growth rate, there wouldn't be in real life. But I'm not quite deliberately, I've made it obvious. That the first year dividend actually fell, then it went up a lot, then it stayed constant, then it went up. But if he did this, all he'd ever expect is you worked out the average growth rate per annum. If on average it's been growing at 2%, we use 2% in the formula. You with me? And so, several occasions, only for a mark or two, he's given you that sort of information. He's expected you to work out the average growth rate per year. All right? Here, it's hard for me to write as a formula, but watch, it's so easy, it's untrue. You can't take an ordinary average. You can't work out the growth each year and then add them up and divide. You know what I mean? With growth rates, you can't. All we ever do is this. You take the earliest dividend, which here is 10 cents. It's one of those things, once you've seen the logic, I think it's easy to remember. But you take the earliest dividend of 10 cents. If it is growing on average at G per annum, you know, if the average is 5% or 6% a year, then surely, if on average it's G per annum, after 1 year it would have grown to that times 1 plus G, like inflating. After 2 years it would be another 1 point G, after 3 years another 1 point G, and so on. You're all with me? Well, here, how many years of growth have there been on the information I've given you? No? 4. Although there are 5 dividends, be careful. Overall, it's grown 1 year, 2 year, 3 year, 4 year. There's been 4 years of growth. And so if on average it was G per annum, after 4 years, it would have grown to 10 times 1 plus G to the 4th. Is everybody with me? What has it grown to? Well, the latest dividend is 13. And therefore there is absolutely no argument. Even though the growth rate each year has changed, some years high, sometimes some years low, the average growth rate is G from that formula. And so 1 plus G to the power 4 is 13 over 10. 1 plus G, I don't know what you call it, but the 4th root of 13 over 10. I said yesterday, to be safe, have a fancy calculator. Although here, fourth root, of course, is square root twice. So fortunately, we can all do it. 13 divided by 10 is 1.3, obviously. Root. Am I right, please? 1.0678? That's 1 plus G. G is 0.0678 or 6.78% per annum. And as I say, I'll argue with anybody later if anybody's upset, but there is no question for the last time, even though year by year it's obviously growing more, some years less others. On average, over that period, it's growing by 6.7%. Okay? Now say I could write that as a formula, but it gets confusing. If you see the logic, that's easy, but remember it. He doesn't do that very often. Usually, if it's relevant, he tells you the growth rate and you use his figure. But if he wants to have a few more marks, he'll do that. Alright? And you get it. Everybody clear? However, the reason we need it, whether we had to calculate or whether he gave you that figure, the reason we need it is for part 2. What will be the market value of the shares if the required return is 14%? Now, he would say, but I've no choice here, we'll have to assume it's 2001, the latest dividend. Hello, you with me? Those dividends I gave you. He won't play tricks, but he would give you the date. But assuming it's now 2001, the market value P0 is D0 times 1 plus G over IE minus G. Well, again, it is sticking figures in a formula. The current dividend is 13 cents. I always work in cents. If you want to work in dollars, it's 0.13. That's no problem. Times 1 plus G, the growth rate, 0.0678. Divided by RE, the shareholders' required return, which is 14%, 0.14, minus G, 0.0678. You'd only ever be using that formula. And of course, it is then just calculator. Incidentally, a lot of people, be efficient with your calculator, a lot of people work that bit out and write it down, and then work that bit out and divide. That's fine, except you get bits of rounding. Why not do the whole thing in one? If I do the whole thing in one, it's 13 times 1.0678 equals, divided by that minus that. If you can't do it in your head, work that bit out first. But that minus that is what? It's 0.0722. I don't know if anybody's checked me, but the correct answer to the nearest cent is 192. That's in cents. It's $1.92. And in theory, there is the market value per share. All right? Now, to go on here and be silly, it's more important surely you practice. But it's very, very, very common. Again, only for 2 or 3 marks, maybe 4 marks, because we have to work out growth rate. But given it's just sticking figures in a formula, again, I am being rude if I need to. That's marks a monkey should get. A monkey might have problems with any written bits, but not sticking figures in a formula. All right? Now you're all too shy to tell me you've got a different answer. But you can practice shortly. All right? One very tiny thing which I doubt to be relevant, but just in case. The value given by the formula, 192, that value does assume that we've just paid the current dividend. That automatically the value the formula gives assumes that they've just paid the current dividend And so if somebody was to buy that share, they pay 192 now. In a year's time, they'll get the dividend of 13 plus a year's growth, and so on. All right? Can somebody tell me, what do we call it? What's the name we give to a market value when they've just paid the current dividend? Say again? Yeah. That is the ex-div value, or the shorthand is XD. Now, so I don't think he'll mention that, but he could. But if you see any mention of ex-div or XD, it means they've just paid the current dividend, and that's the value that comes out of the formula. All right? The reason I mention it is, however unlikely, he could ask you what the value would be. He could ask you what the share price would be if you'd bought it a few days earlier when they were about to pay a dividend. So if they were about to pay the current dividend, you're all with me? See, in that one, buy the share, they've just paid a dividend, you wait a year. If I was buying it a few days earlier, buy the share, and I'll get the current dividend. You all with me? Anybody, what do we call it if they're about to pay the current dividend? It's cum div. The words are cum div, and there's no abbreviation. But if you ever see mention of a cum div share price, it means they're about to pay the dividend. And, well, although I'll write it as a rule, it should actually be common sense. If you were going to buy the same share a few days earlier and you'd get the current 13 cents, how much would you pay for the same share? The same share we've just done. If they've just paid the dividend, you'll pay 192. If you were to buy it a few days earlier, so you buy the share and you're going to get the correct dividend, how much would you pay? You'd pay 13 cents more, surely. Surely. Pay 192 and you have to wait a year. But if I was going to buy it and immediately get back 13 cents, you'd pay 13 cents more for it. But all right, I'll write it as a rule, but the cum div value is equal to the ex div value plus the current dividend. Now say it is much, much less likely, but it's so trivial it'd be a pity not to mention, that here the market value of this share cum div, the formula, remember, always gives you the ex div value. So the formula gave us 192. If he did want a cum div value, add on the current dividend, and what was it? It was 13 cents. So in fact the value would be 205. So the arithmetic's a joke. I've got to move fast here. I'm not giving you time to think. If you're still at all unsure, look back in a few minutes. Ask me if you need. All right? Finally, I don't want to confuse anybody. For the exam, if he says X or cum div, there is no argument. It's 192 or 205. Usually he doesn't say anything. For the exam, if you're not told, you always assume it's ex div. If he doesn't say anything, and he said, what's the value? It's 192. But just check. If he says it's cum div, or he says they're about to pay a dividend, then in fact it's the 205. Okay? But I hope that on its own is easy. I say again, not to get marks for that bit would be criminal. Well, I wouldn't even admit it after the exam. You've every excuse for other bits, but you deserve strangling again if you get that wrong.